Caitlin, why don't you go ahead and start us off today?
Okay. So as Charlotte mentioned, what we're going to be covering is some of the top questions that you'll want to ask your CPA about your tax-exempt organization. And on this slide, we have an agenda of what we'll be covering today. So the first thing that we'll be covering is charitable contributions, substantiation, and disclosure requirements, in-kind contributions, quid pro quo, advertising and unrelated business income tax, private foundation minimum required distributions and tax on investment income, qualified charitable distributions, gifting appreciated stock, nonprofit student loan forgiveness, and then we've also included some resources for you. So first, I'll be covering charitable contribution substantiation and disclosure requirements. Some of the commonly asked questions that we see are, what documentation should we keep for donations? How do I ensure donor records are compliant? Is my organization responsible for providing donors with documentation for their donations? And is my organization responsible for determining the tax deductibility of a donor's donations? So regarding cash donations, we recommend that you keep a bank record such as a canceled check or a bank statement for proof of the donation. Written acknowledgement from the charity should include a few items, specifically the organization's name, the date, and the amount of the contribution. For larger donations, there might be some more detailed statements that are required to ensure that no goods or services were exchanged along with the cash.
And this is for the documentation for the people that are actually giving the money, because they're the ones that really have to prove when they're audited by, the IRS, or what they're reporting on their Form 1040, their individual tax return, okay, yes, this is the amount I reported and why. So
Yeah, so this is what you would want to be giving to your donors. Regarding non-cash donations, we need to provide record of the description, its condition, and as well as the fair market value. For high valued items, an appraisal may be required. And it's important that the donees maintain these records of these items so that way they can support the value and allow for the proper deductions when they claim in on their individual tax returns. When goods or services are supplied in exchange for a donation, that needs to be explicitly stated on the donor acknowledgement. The amount and the value of the goods or services must also be stated. The donor must be informed that only the amount exceeding the value of the goods or services is tax deductible. This is especially important for events where donors receive something for their donation. The main intent is to ensure that donors are fully informed and the proper amount of the donation is deducted. So in here, we have an example. We see this quite often where there might be a fundraiser, and with that, you receive a value for a t-shirt for signing up for an event. So for a donation of a $75 t-shirt is given to the donor. The t-shirt has a value of $20, therefore the amount that would be deductible and eligible to be claimed as a charitable deduction would be the difference, which is $55.
And on your point one on these, I get this question every so often. Who is required to, give the fair market value and things like that. And, if you think of the Salvation Army or the Goodwill receipts and things like that, they'll give you a blank statement saying that they received goods, but a lot of times the value's not on there. And it is up to the donor to substantiate that, I gave 3 bags of clothing, and I value it at $100 or this and that. So ultimately it is on who's giving that donation. Except when you get into like some of those higher thresholds and things like that, there actually is, well, you'll get into it, so I won't get into it more, but.
And what Shannon pointed out, like organizations such as the Salvation Army and that, so if you do get those slips and you're trying to come up with a value, they do have on their website, a suggested range of values to use reasonably for what you would list as the fair market value for those donations. Again, the value of a non-cash donation will be determined will determine the documentation that it requires. Donations of property in the value of less than $5,000 must be listed on Form 8283. This form will list out the value, a description of the property, as well as its condition. and donations of property with a value over $5,000 require a qualified appraisal. The organization's disclosures to donors. They need to provide acknowledgement of donations of all kinds for the donor's records. Clearly inform the donors of the value of any goods or services received in return for contributions. Again, we're talking about that example we had with the t-shirt. So you would need to provide any type of value related to goods or services received. Specify the amount or portion of the donation that will be deductible. It's really important, again, to specifically identify the costs related to events or sponsorships. So some of the basic donor receipt requirements that need to be included are the name of the organization, a statement that the organization is recognized as a tax exempt by the IRS under 501c3, the name of the donor, the date of the donation, and the amount of the donation. The cash contribution and description of non-cash contributions also be included. On the slides, we provided an example that you can use or fill in the blank for modified as well as needed for your organization. This is a nice guide on how to give a letter to your to those who donate and kind of outline those things that we just noted that are required by the IRS as to what needs to be included as a receipt for those donations. Again, you need to maintain the proper documentation of donations from donors to remain in compliance. Structured documentation reinforces donor confidence, and maintaining these records helps strengthen the nonprofit's compliance and helps donors meet their tax obligations.
You know, sending these receipts too are a nice way for the organization to thank the people that have been giving them monies, you know, other services and things like that. So, you know, hopefully it encourages them to give more. So don't think of it as an additional task or anything like that, but more of, you know, kind of like a thank you and hopefully encouraging for them to give in the future as well.
And it's kind of like free marketing. So you get the opportunity to put your name in front of them again, remind them, oh, maybe they donated early on in the year, and getting that at the end of the year, they might remember, okay, well, I want to donate there again. So it's a great reminder as well.
Sure. I've gotten receipts multiple times, you know, okay, once when I gave the donation and then like at the year and to just kind of summarize, you know, how giving you were. So.
So donors can deduct a charitable contribution of up to $250 without written acknowledgement. Donations over $250 must have written acknowledgement for the deduction purposes. Non-cash contributions bring on more responsibility. The donor must maintain a record of description, condition, and fair market value of the items donated. Any goods or services related in exchange for the donation must be disclosed. And again, this information related to non-cash donations should be listed on Form 8283. So on the slides, we provided an example or a copy of the Form 8283 that we've been referencing. Most commonly with individuals that we see, we usually fill out page 1. Not always do we have page 2 included. Page 1 kind of goes through, Section A covers the property that's 5,000 or less. And again, there's the key areas that would need to be filled out, such as the description, the value, and the date of the contribution, the organization's information. Sorry, my eyes are a little tiny for me to read. Okay, so part 1, the second section, that would be for items that are over 5,000. And then on page 2, that's where it gets into when an appraisal is required. So anything that would need some significant substantiation. I've seen it sometimes where clients have donated a piece of art or a car. That value would need an appraisal to support what you're claiming as the value for your donation. So that's where we would get into the second page. And again, if there is an appraisal that is required, there's a signature section that needs to be completed as well. And we'll be going into our first polling question. So does your organization provide donors with donation acknowledgements? No. Yes, automatically for all donations. Yes, but only when requested.
And hopefully for well-established 501c3s. This was just old refreshers, items like that. But, you know, once in a while you get those questions, those oddball questions of, what do I have to give for? What is there a threshold limit and things like that? But once you have your template set up, it's pretty straightforward.
All right, we're almost done. Hopefully you get your answers in. Well, it's good to see. Automatically for all donations, 74%. The next section I'll be covering is in-kind contributions and quid pro quo. In this area, some commonly asked questions that we see are, how are donations of goods or services properly reported? Does a receipt of goods, services impact the amount of the donation the donor can deduct? And are there goods or services that are not allowed to be exchanged? So by definition, an in-kind donation is another term to describe a non-cash donation. Examples include goods, services, or time. Quid pro quo in simple terms means something for something. So a quid pro quo donation is one that is partly of cash and partly for goods or services. The value of goods or services reduces the amount of the charitable donation deduction that can be claimed. A quid pro quo donation occurs when the donor receives goods or services in exchange for their contribution. Common examples include a t-shirt, a meal, or a few other items. The organization must disclose in a statement to the donor the specific value of the goods and services received. Note that only the amount of the contribution in excess of the value of goods or services received is tax deductible. These statements are very important so that the donor can be provided with accurate information and avoid overstatement of deductions. So for example, an individual makes a $100 donation and as a result of that donation, they're given a $40 event ticket. The tax deductible portion would be the $60 difference because they received a benefit of $40.
And I get the question as well as how do you value that event ticket, things like that. And I mean, there's obviously different ways, different things that go into it, but you pretty much know what your costs are going to be. So one item might be, accumulating those costs, maybe the entertainment, the food, the event space, and then dividing it by, approximately how many people you've had there to kind of come up with a roundabout number. Might be one way, but obviously there's different ways depending on the event or depending on what the person is getting in return to determine that amount. So
yeah, it gets a little more complicated if you don't have, the option to just have those items separately sold. So then you need to come up with a better value. So it's a great way. Requirement of disclosure. Organizations are required to provide a disclosure statement of the value of goods and services exchanged for a donation. Quid pro quo donations of more than $75 must be disclosed in a statement to the donor to avoid penalties. The disclosure must inform the donor that the deductible portion of their contribution for federal tax purposes is the amount by which the donation exceeds the value of goods or services received. It's important to provide the donor with a good faith estimate of the fair market value of those items. So again, that's what we were just kind of discussing. So substantiating a value for the services or goods that they're receiving on top of with their donation. So according to the IRS, there are some instances where a disclosure statement is not required. If any of the following apply, a statement is not required. So if the goods and services are given have an insubstantial value, if there is no donative element involved, so an example that would be there's someone purchasing an item from a gift shop there is not a donative element when someone buys something from a museum gift shop. So you're obviously paying for that item that you purchased. There's no donation involved. There's only an intangible religious benefit provided to the donor. An example there would be where a donor is allowed entrance to a religious ceremony in which there's no admission charged, only an intangible religious benefit is provided. Or the donor makes a donation of $75 or less per year and only receives annual membership benefits. There is a penalty for failing to disclose. So charities that do not make these required disclosures of quid pro quo contributions that are valued at more than $75 are potentially subject to a penalty of $10 per donation. The maximum penalty is not to exceed $5,000 per fundraising or mailing event. And this penalty can be avoided if the proper disclosures are distributed or if the organization can show that the failure was due to reasonable cause. And now we'll go into our second polling question. What does the Latin phrase quid pro quo mean in simple terms? I don't know. Something for something, seize the day.
We didn't go over it. I would be. The real answer this week. Or if you don't know Latin.
Yeah.
2 seconds left here.
So we just want to acknowledge that there may be some technical difficulties with Conference IO today. If you have problems, please just send us a message privately in the chat and we'll make sure that if you need CPE credit, that we grant you CPE credit.
Okay, so 92% of people were paying attention and got that one right.
And there was a question before we move on to the next topic that came in.
Did you see that?
Yes. So does a library friends group that's a 501c3 also need to provide donation statement? So as Caitlin kind of went through, individuals that are looking to take a donation on their individual returns are required to substantiate that donation of anything that's $250 or more. So it's good practice to, give them a donation statement anyways. You should definitely do it for the $250 and above, just so that they can substantiate their records. But then, like we had mentioned before, I would just get into the practice. You have that statement. It's a nice thank you. It's nice advertising kind of for your organization as well. And then, there's the other separate requirement for the quid pro quo. As Caitlin said, does have penalties that could be attached with it if you do not give that documentation. It's over the $75 limit.
So now we'll be getting into advertising and unrelated business income tax. Some of the commonly asked questions we see here. Do we owe tax if we sell ad space or sponsor an event? And what activities trigger unrelated business income tax? So advertising is how nonprofits improve their fundraising and outreach efforts. While advertising that promotes the organization's own programs or services generally are considered to support the organization's mission, certain advertising activities can trigger tax consequences if they are unrelated to the organization's exempt purpose. So UBIT is triggered by income derived from a trade or business that is regularly carried out, but is not substantially related to the organization's mission. Mission-related advertising typically is not subject to UBIT. Promoting the organization's own programs, services, or initiatives are examples that would fall under this category. Unrelated advertising will typically trigger UBIT. This includes selling ad space in newsletters, websites, or event programs for commercial businesses that are unrelated to the nonprofit's mission. To ensure that your organization will not be subject to UBIT for advertising, make sure you keep accurate records of the purpose of all advertising activities. Distinguish between any mission-related and unrelated advertising. Report any unrelated activity and pay the applicable UBIT to avoid fines and penalties. Some common triggers for UBIT include any unrelated trade or business that's carried out by the organization. It's important that all activities carried out are related to the exempt purpose of the organization. If not, they may be put into a position where they have a tax liability despite their nonprofit status. Some additional examples of activities that can trigger UBIT include certain advertising, sales of goods or services to the general public, renting personal property, and public use of facilities.
This is one area that I probably get the most questions on. And they're very specific to the organization. Because it, like most questions related to tax, like the answer always is, it depends. So, I urge you to reach out if you do have any circumstances that you think might be subject to the unrelated business income tax. So reach out to your accountant and ask them, oh, we're starting this new activity or doing this new thing. What do you think about this? Because it would depend on, your mission, what programs are you doing? What is your mission, first of all? And then how much of the activity you're doing, that can be a factor as well. And then, it also depends on too, like, for example, if you're renting, like facility space, okay, is there a mortgage on that? There's just a lot of different factors and a lot of different items to look into. So, to answer, broadly individual circumstances is kind of difficult. And sometimes it requires more research and digging into what are you doing, how often, and things like that. So. But it can be very specific, and what might be UBIT for one organization doesn't necessarily mean it's UBIT for another organization as well, so.
As with most tax law, it's always answers, it depends. So
Yeah,
if you're unsure, make sure you're talking to your accountants, your tax accountants, or reach out to us if you have a specific question. We're here for help when you need it.
and advertising is probably the main one that we see. And one of the areas too of advertising, they're saying, oh, well, the money comes to me, so it's for my mission. Okay, yes, well, anything you do, hopefully it's going to your organization, your mission, but it's more of the who are you advertising for? Like, are you advertising your organization's programs and services? Or is it someone from unrelated for-profit company is just advertising in your space or for your event, things like that. So, ultimately, yes, we know like the money, you are collecting the money and it is going to ultimately go to your programs and services and things like that. But, it's more of who's advertising initially benefiting that's bringing in the money. So that's why we kind of hit on that one. But there's lots of different circumstances. So like I said, definitely reach out if you do start some kind of new activity or income stream and things like that. So, okay. All right. So if you haven't noticed, this year, our presentation, we weren't really going through like the 990 and exact circumstances and things like that, but more trying to hit on throughout the year, like what kind of things that we've been hearing, people are questioning us about, and things that kind of needed like more of an explanation on those hot topic areas. And also, I haven't hit on private foundations in I think quite a few years or anything related to them. So I do want to kind of go through a little bit of a 990 PF and the private foundation. Since we're not hitting on the regular 990s, I'll hit on the 990 private foundation just a little bit. And those two kind of main topic areas that we do get questions on, and how to calculate things and what should I be doing. So the first item is the minimum required distribution. So like I said, this relates to the private foundations, those organizations filing the Form 990 PF. And generally private foundations are required to actively support charitable purposes rather than indefinitely accumulating assets. So I'm speaking generally now. A lot of private foundations, they might have received a big amount, they hold an investment account from initial contribution to then help support other charitable organizations, 501c3s and things like that. Well, to kind of circumvent these private foundations from just having all this money that was donated into the private foundation, sitting in an investment account, growing and earning incomes and no tax ramifications or no way that they are kind of pushed to distribute these assets, they have two requirements, minimum required distribution and also excise tax on the investment income. So what is the minimum required distribution? So minimum required distribution is a certain percent of the asset value each year that must be distributed. loosely said, we'll get into the calculation a little bit further when I have a page of this page of the 990 PF come up. But it's about 5% of the average fair market value of the investment assets that must be distributed each year. And the monthly value is actually, we have spreadsheets that we do to kind of calculate this, because it's not just like the beginning of the year, the end of the year. What we basically take is the beginning of the month, end of the month, average it for the year, and we do that for their cash. We do that for their investment values, so on and so forth. Or, if they have multiple accounts, multiple cash accounts, multiple investment accounts, taking those averages to determine the 5%. And then also there's, we subtract out the investment tax and things like that. So, but on average, if you're trying to determine what is the amount that I should have to distribute, it's about 5% of those assets. And if you can have the calculation a year ahead of time, meaning, so for this upcoming year, the 2026, saying the private foundation's on a calendar year, the 2026 minimum required distribution that should be made by 12/31 should already be determined. When you filed your 2025 Form 990 PF, which including extensions, the latest due date would be November 15th of 2025. It would have that amount that would be required to be calculated. And that gives you, a full year of okay, oh yes, or almost a full year you would have had, because you have up to November 15th to like true it up and things like that, if they're required distribution. So you do have some time, you do know what that amount is before the end of the year. So what are qualified distributions? So there are a few things, and this is also a misconception as well. If they think some people think that qualified distributions are just the amounts that you give to other charitable organizations. That obviously does count towards it, and that is probably the biggest chunk of the qualified distribution for these private foundations. But it also can consist of a few different things. And you'll see later on a slide as well, where we kind of go through the allocation of some of these expenses to what can be considered expense that can count towards the qualified distribution, expenses that can count towards your investments. So as for qualified distribution, in addition to your grants for public charities, you also have some administrative expenses that can go into grant making. Anything that has to do with charitable programs or other assets and expenses associated with the foundation's exempt activities. And as I noted before, expenses related to investment management do not count, and you'll see this further on, kind of how you do this allocation or determine which ones are qualified distributions and which ones are expenses for investments. So you're never going to get it dollar for dollar unless you're like tracking daily and very thorough. So any excess distributions can be carried forward 5 years. So when we give the amount, okay, this organization has to distribute $846,511. We always say, just in case some of these allocated expenses and things like that might be a little bit less than you're predicting for the year when the year end actually ends, maybe give a little bit more, give $850,000 just to make sure you're covering the excess and things like that, and you're not losing anything. You'll see on upcoming page of the Form 990 PF how that amount carries forward for the 5 years and things like that, and that excess actually goes into the calculation to determine the next year's qualified distributions. Like I said, you kind of don't want the shortage, because there is a possibility that you would be subject to a 30% excise tax for each year that you don't make this qualified distributions, with any penalty and things like that. There are ways to get around it, especially if it's not willful neglect, and if you make up the difference as soon as you are aware of it. But you probably don't want to get in that circumstance to begin with, because you have to file a Form 4720, and it's just extra additional steps. But so just make sure, once by November 15th of that year, that required distribution amount, you're distributing either that amount or more. And then as far as penalties as well, if you know about the shortage, you receive notice, you still fail to rectify that, which I don't know any organization that would or fall into this, but there isn't a 100% tax or penalty. So that's the minimum required distribution. And then next we have the tax on investment income. So this is the other piece that you have to be aware of. Private foundations, and you think, oh, we're a not-for-profit, we don't owe anything, but you would. So if you have your investment account and it is generating interest, dividends, capital gains, those type of things, that would be subject to a tax rate. Way back, well, I say way back when, but before 2019, it used to be a 1% or a 2% rate based on other factors and things like that. But as of December 20th, 2019, it is now a flat 1.39% rate, which makes it easy to calculate for most of us, that you're taxed on this investment income. So it's actually the investment income less expenses allocated to it. And we'll kind of go on to that. But first, let's do a polling question. So what percent of fair market value of assets is a private foundation required to distribute? And this kind of relates to my previous discussion on the minimum required distribution. So is it 5%, 10%, or 15%? Hopefully you're listening, even if you don't really deal with private foundations too much.
Few seconds left to get those answers in.
Okay. Oh, got about half of you listening. So it is 5%. Like I said, that was a loose calculation. But distributing more, I mean, 10%, 15%, you're doing good. Distributing more is not a bad thing. Oh, no, my slide didn't get in there. PF example. Okay. Well, my Form 990 PF that I had, oh, it didn't get in there. But anyways, so when you're doing a Form 990 PF, starting with like part 9 of the form is where you would calculate the minimum investment return. The next section is the distributable amount. Section 11 is the qualifying distributions. And all these sections feed into the part 12 of the Form 990 PF. That basically calculates, here's the current year's required minimum distribution, less what was actually distributed, any carryovers to determine your net amount. So just kind of looking at those sections, Form 990 PF, like the Form 990 is pretty voluminous in a lot of pages, but starting with those section 9, the Form 990 PF, you get into that. Okay, so kind of going on a different page. So excise tax on investment income, as I had stated, with the private foundations, I kind of didn't finish my thought on that, but just be aware of that there is an allocation between the investment expenses and related to that, and then the private foundations related to the qualified charitable or required minimum distribution for charitable organizations. So that'll end the private foundations. And now what we wanted to kind of get into is some of these questions that we have on all of our tax-exempt or charitable organizations that are looking to kind of motivate their donors on how they can give better. or actually encourage others to give more. So the first kind of tool that we say, should kind of push, make your donors aware of, especially those higher earner taxpayers, or the more of the, not the elderly, but I don't want to use age 70 and a half, those middle age people, as a qualified charitable distribution. So each year, if a person has an IRA, they are required to do a distribution, and it's based on the value of their IRAs, and most of the time their broker will determine that value for them. This amount from a regular IRA is taxable to them. However, if a portion of that is given as a qualified charitable distribution, they can escape bringing that income onto their tax return, and instead, save on that taxable income. So that is one tool. As I said, the eligible distribution must be for 70 and a half or older, must be transferred directly from the custodian to the qualified charity. So a lot of times we just have you contact your financial advisor, the brokerage account that you work for, and they will facilitate this for you. Kind of one item I will say is that we still get the regular form 1099-R at the end of the year, and it'll report the full amount of your required minimum distribution. So you still have to let your tax preparer know what amount of that went towards a qualified charitable distribution or was given to the charity, so that they know to reduce your taxable income that way. And just to kind of let you know too, it's not because this is reducing your taxable income, you can't double dip on it. So it's not going to be an itemized deduction as well. So it's either or. There are certain contributions that do not qualify as a qualified charitable distribution. And these are amounts that are given into a donor advised fund, private foundations. And I will say that there's a couple different categories of private foundations: operating and non-operating. So specifically here, when we're speaking of private foundations, giving to a non-operating foundation does not qualify, but an operating foundation would. And then the limit changes each year based on inflation, things like that. So say your required minimum distribution from your IRA is a couple $100,000, you can't just give that whole amount to a charity and not take that into taxable income. It is limited, and for 2026, this amount is $111,000. Like we said, you should document this, because that 1099-R that you get at the end of the year isn't going to state the amount that was given as the qualified charitable distribution. So if you can have, some kind of reporting statement, like I said, if you're doing it through a financial advisor or brokerage account or things like that, they can show the money going directly to that charity for you, or a receipt from the charity that they received it is always good as well. But just make sure you're passing that along. Next is gifting appreciated stock. Maybe. Okay. So this is another avenue that could help you with encouraging people to donate. So especially towards the end of the year, which now we're past the end of the year, but keep this in mind for upcoming, when people are meeting with their financial advisors, going over their accounts, things like that. They might be trying to clean up their portfolio or what they're invested in. And they might have some stocks that they've held on to for a while, and they want to re-diversify their accounts and things like that. There might be some stocks that they held for many, many years, or great stocks, maybe invested in Amazon back in 97 and you still have that, and you're looking to, maybe get something else besides Amazon, but you don't want to take in these huge capital gains. Gifting that actual stock to a charitable organization is a great way for the donor to avoid the capital gains that they would have to pay on. So, you know, they're still giving you the same amount of value. The charitable organization would be, you know, responsible for doing what they would with the stock. Maybe they want to hold on to it too, or if they need that cash right then they can sell it. You know, so just make sure that the donors aren't selling the stock before giving it to you, because then that kind of defeats the purpose of it. But actually gifting that appreciated stock is definitely a good avenue. And like I said, the donation should be directly to the charity from the donor to avoid the capital gains tax. And this increases the donor's giving power. You know, they're saving that 15-20%, depending on what tax bracket they're in, of tax that they would normally have to pay on that capital gains tax. And then, you know, maybe it'll be increased donation that they would be willing to give to the charitable organization.
I've seen that on a few of our clients where they'll gift it if they have very low basis and they're trying to avoid that huge built up gain. But they'll make a donation, and usually the advisor gives us documentation to support that.
It's you know, the form that you went over before as well. You know, you have to list out like the number of shares, the value of the date, and value the date, things like that, just to substantiate it too, especially if it's over that 5,000. That's And we kind of went over this, where the stock must be transferred directly to the not-for-profit and then before being sold. You know, and you should have guidelines set up internally on how you receive, process, liquidate these securities. Maybe you already have an investment account set up to kind of handle these and for easy transfer in of these amounts. And then also definitely retain some written acknowledgement. Like I said, the tax preparers will be asking for that to report the end of the year on that form 8283. All right, so who does gifting the appreciated stock benefit? Well, benefits the donor as long as they can donate it, and also the charities will maximize their benefits as well, and it also benefits the organization. You know, they have some flexibility too, like I had mentioned before, whether they want to keep that asset, maybe it'll grow even further, or if they need the cash now for some program or service, support their mission. So I kind of just gave my question away, but so full question, if you're listening, perk up. Who does a gift of appreciated stock benefit? No one, the donor, or the organization and the donor? Few more seconds here to get your poll questions answered and in. Okay. All right. Sounds like everyone's listening, or they just knew the answer to begin with, so.
We'll go with their list.
Yes. All right. So I've hit on private foundations. We hit on hopefully a couple tools for you to encourage those donors. And then another topic area that we've, you know, been seeing people asking questions about is, you know, staffing is an issue as well, and keeping employees and motivating them. And, you know, you deal with competitive salaries and for-profit organizations, things like that. So what can we do, you know, especially on limited budgets and things like that? So there's a student loan forgiveness. It's actually called the Public Service Loan Forgiveness, and my title is probably a little bit misleading because it's not just for not-for-profits. It's actually it's a program for government and not-for-profit to be able to get some student loan forgiveness they may have. So once a person has made 125 or 120 qualifying monthly payments under acceptable plan while working full-time for an eligible employer, they may be subject to some forgiveness. And we'll get into some of the details of this on a few of these additional slides. So there is an application involved. And in the resources at the end, we have the website there that if you think anybody might be eligible for this or looking for this to kind of go. And there's a tool to assist in completing the application as well. So first off, it has to check if the employer is already in the database. If it's not, and you think the employer is eligible for it, there will be steps to be able to get that eligibility in there. And then obviously there's things that you have to sign and request certification. The employer or the tax-exempt organization has to sign off on this as well. So how do you know if a employee or a person will qualify for this forgiveness? So they must be employed by U.S. federal, state, local government or a not-for-profit. They must work full-time for the agency or organization, which we'll go over what qualifies as full-time. And then they must have a direct loan. And there's consolidation that can occur and things like that. So they definitely have to make sure the types of loans that they're paying off and things like that are considered a direct loan that would qualify for this. And there's different plans, repayment plans under this, but in short, they have to have made 125 qualifying payments, which is typically, a 10-year period. And they don't have to be consecutive. Like I said, it's generally 10 years because you generally make one payment a year, but overall it's 120 payments. And so as far as employment, it's the employer that it matters. So since you're a not-for-profit, a 501c3, they're working for you. That's qualification enough. It doesn't matter if they're not doing the actual charitable activity of organizing and running the programs. They might be your accounting person that's sitting there, but because they work for you, they would be, eligible. And full-time employment is actually considered 30 hours. So if you're thinking it's the 40-hour criteria, it's actually a little bit less than that. And it has to be during the period that's being certified. So that's 120 consecutive payments or about 10 years that they're looking at the period for this loan forgiveness is when they should be full-time or 30 hours. And a couple little caveats there as well. If there was a break in service, for leave taken under the Family Medical Leave Act, that can be included in there. However, volunteer work is not included. So you definitely have to be an employee, not just a volunteer. These are the types of eligible loans. Like I said, make sure you're looking at this first to make sure it is a eligible loan that was being paid. And the qualifying payment is a monthly payment made while employed full-time by the qualifying employer while under the qualified repayment plan. So can't be paid 5 years, then you worked for the not-for-profit for another 5 years. No, it has to be 10 years while you're employed. And these are the income-driven repayment plans. There's a few of them. Income-based repayment, income contingent, pay as you leave, and saving on a valuable education. So that concludes our presentation today. And as I stated, we did have some resources that we always provide you with, and you'll find these in the back of the presentation as well. Yeah. Any questions? It was kind of a quiet group today.